Hi, Gary. Good to see you.
Good afternoon.
6 months out from a banking crisis, if we can call it that. Have we?
I don't know if it's a crisis.
It
Maybe
tried to be one, didn't quite get there.
self-inflicted wounds, but okay.
Great. Have we seen the last fatality there?
No.
Okay.
No,
Say more
no.
about that.
So, like I said, self-inflicted wound. You sort of have to back up, and 2 guests ago mentioned it. He talked about the zero interest rate policy we had, and we had a Federal Reserve chairperson talking about zero for longer, zero forever, and then we'd have zero interest rates for a long period of time. And then we went through COVID, and we went through massive stimulus being put into the economy, being put into retail consumers' hands. Retail consumers had nothing to really consume. If UPS, FedEx, or the United States Postal Service couldn't deliver it to you, or your grocery store didn't have it, you couldn't spend money on it. So we forced all this money into savings accounts. Banks have to invest it somewhere to pay for your savings. They put it into what they're exactly supposed to put it into, something called a risk-free, zero risk-weighted asset, otherwise known as U.S. Treasuries, because we all know they redeem at par if you can hold them to redemption. The only problem is we started having massive inflation because of all this money put in the system. And then people decided all at once they wanted their money out of a bank. Now, banks aren't designed to have all their money come out. And so you see a run on the bank, and you see banks having to sell treasuries, and you create what many call a banking crisis. I call it a little bit of a self-inflicted wound. And now you're in a situation where banks still don't really pay for deposit. Oh, they didn't like that answer. Where banks really don't pay for deposits. Today, the average banking account pays probably sub 1%. And the US consumer is really pretty smart. They figured out that money market funds are paying over 5%. So we've seen over $1 trillion leave the banking system to go to money market funds. And on top of that, we've now spent enormous amount of that additional dollars that were put into savings accounts. So banks' balance sheets today look dramatically different than they did 12 months ago. Hence, loan creation does not really exist because banks don't have excess deposits to loan. And on top of that, the Federal Reserve is most likely going to solve the prior banking crisis the way they solve every crisis, is they're just going to raise capital requirements. So banks are hoarding capital. So you put all those things together, and it's making it very, very difficult for these small and medium-sized banks to really thrive at this moment.
I mean, we've gone from sort of an acute liquidity, solvency crisis, whatever, to kind of just like a slow-moving earnings crisis. And usually the way out of that is consolidation.
Yes.
Sort of a non-starter, it would seem. You can either do it sort of emergency over a weekend, or you can let it happen.
Well, again, we've probably created a little bit of a situation where we have a regulatory environment right now that's not that friendly to mergers. They're not that friendly to consolidation. They think that smaller is better. In the banking world in particular, they have been pretty anti-mergers. Of course, if you're getting close to merging and you think you're merging because of a solvency issue, you should wait till you become insolvent. And then you can probably do it more effectively with the FDIC's help or the Federal Reserve's help. So we've created this sort of prisoner's dilemma in the banking world. I do think we will see consolidation. Unfortunately, we'll see it in the negative fashion. We'll see banks run out of capital, and we'll sort of see brokered marriages through the regulatory community, in spite of the fact that they should be out encouraging a lot of these banks to get together now and create real synergies and real economies of scale.
You're talking about raising capital requirements, so there's some international stuff. Basel is coming in. The Fed has obviously hinted at sort of their own thing as a response to what happened in the spring. For the moment, that dovetails nicely with their policy goals, right? They would like to make capital more expensive. They'd like to cool things down. I don't know where you think will be on the other side of this, but I don't know. What is the right way to tailor that? Because right now it's pretty convenient to do that, but there'll be a day when we're trying to ramp up growth and get new loans out there, and you always inherit that regulatory baggage.
Well, in the banking regulatory community, remember their policy is we want to protect the depositors at all cost. We're not really graded upon growing the economy and creating loans. we don't really, as much as Congress would say it's our incentive and it's our goal to create home ownership and create small businesses because small businesses grow the economy, the banking regulators don't sit there and say, oh, did you lend money to small businesses? Did you take risk? In fact, if you took risk in lending money to risky people, we're going to give you capital haircuts. So banks, in essence, lend money to the most creditworthy people they can find. In fact, it's better to lend money that people don't need to borrow money than to lend money that people need to borrow money, because the capital that you need to put up is substantially less. And that's unfortunately not the way that you grow the economy.
How do you think the Fed has done? We'll take the one from the mayor, A to F.
A to F. C minus.
It's tough.
It's just a little bit below average.
What's too slow to start, raised too quickly, should be done by now? What's your...
Look, definitely too slow to start. We go back to the old transitory inflation. There was nothing transitory about the inflation we had. There was really sound data and sound evidence that we were having real inflation in the system. And it wasn't going away tomorrow. It wasn't supply chain issues. It wasn't, factories being closed. There was real inflation. There were way too many dollars chasing too few goods, and it wasn't going to rectify itself in weeks or months. And I think we continue to see that. And we've got some inherent issues in our inflationary stance, lack of energy policy. I would say our relationship with China continues to be troubling. We continue import taxes on a lot of goods that people need to buy and want to buy, and it's a consumption tax. So we continue to create inflation in ways that we may not even understand we're creating it. It was there pretty early. So I think the Fed was late to the game. When you're late to the game, you start out saying, okay, I got to dip my toe in the water, so I'll do a 25 basis point increase. And then you realize, oh my God, I am really late to the game. I got to play catch up. So we'll go from 25 to 75 really quickly. And I know these 75s aren't having effect, so we'll do a bunch of them. But anyone that's studied the history of monetary policy will know there's a cumulative and lag effect. And the lag effect is a year plus. So we're now starting to see the effect of the early increases. And one could argue that even those early increases have failed to achieve what the Fed was trying to do. What the Fed was trying to do is slow down the economy, stop consumption, stop dollars chasing goods, and usually you would do that by slowing down economic growth, and that would show up in the employment data. The most obvious way to do that is you make the cost of funding too expensive, companies start consolidating or retracting themselves. They retract by laying off workers and stop hiring. Employment goes up, wage growth goes down, and therefore you see consumption go down. We have seen none of that come through the economy. In fact, we got JOLTS data today, which is job openings data, and
still incredibly high.
Jobs went up by 5.8% as of the end of August. So we continue to have close to 10 million job openings in the United States, in spite of the fact that we've raised over 500 basis points of interest rates in the United States. Now look, there's probably a reason for that. As the Federal Reserve's tightening monetary policy on one side, the federal government on the other side keeps spending money. They keep stimulating. We've got all of these infrastructure plans. We've got CHIP plans. We've got the Inflation Reduction Act. We're hiring a lot of people to fulfill all of the needs of the federal government. Some of these are very valid needs. I'm not saying they're not needs, but it's very difficult to slow the economy down while the federal government's putting trillions of dollars of stimulus in on the other side.
Looking back, to your point, like the regional banking crisis was, if you looked at a bank balance sheet, you said, yes, clearly rates are going to go up and this is going to be bad. At the time, took a lot of people by surprise. Are there other places in the economy where this is going to show up and the spring is going to fly loose? And I know, where should we be looking for sort of unintended consequences?
Well, it's never shows up where you're looking for it. So, the one thing I know from running a trading business and running a bank for a lot of years, it's never going to happen where you think it's going to happen. So everyone's been talking about commercial real estate. They've been talking about the mortgage books. That's probably not going to be the problem. it's not going to be the problem because everyone's looking at it. And you 2 guests ago we had a guest talk about where do you turn the keys in, what's film, what's not film, and I think everyone's going through that, and the banks understand that's what's going on. If there's going to be a crisis, it will be somewhere else. Right now, consumer debt, we're at all-time records high. We're at $1 trillion of consumer debt, and we just started repayments of student loans this month. So the consumer, I don't think we're talking enough about where the consumer is. Now, savings is still pretty decent. It's just outside the banking system. So I don't think there's a consumer debt problem today. But if we continue on this trend of people thinking that wage growth is going to continue on ad infinitum and people are going to continue to consume, the consumer debt to me has a bit of a tinge of something that we're not looking at that could be a problem. And this is in the could be camp.
Okay. On China, as you mentioned earlier, you are, I think, fair to say, a vocal free trader, been for a long time. You've called for lifting. You're not a fan of the tariffs that were put in under President Trump, for whom you worked at the time. But since then, the competition with China is only getting fiercer. The national security interests. I don't know, a revision to your stance. Where are you now?
No, look, I'm a free trader, so I'm not going to get upset when you call me a free trader. Okay. I was the quote-unquote globalist in the White House, and I took...
It's lonely.
I like that. I like the fact that I thought about the world, that I didn't think about the micro. That said, when I think about tariffs, I don't have a problem with certain tariffs. If we manufacture things in the United States, and we can self-sustain ourselves, and we've got a competitive advantage, and another country is trying to dump something in this country, we should put tariffs on that. I think that actually makes sense. That's not what we were doing. What we were doing is we were taking things that we had zero manufacturing of, that were completely essential for our way of life and our well-being, that every consumer wanted to buy them every day, and we were putting a tax on them. To me, that's a consumption tax. We're just inflating the cost of goods, and it's a regressive tax. It's really taxing poorer people in the economy because they're the ones that are paying the tax, and they're the ones that are losing purchasing power by buying more of the goods that are imported from China.
Talk about labor. Seen a real resurgence in organized labor, though in the scheme of things, historically, a bit of a drop in the bucket. Is there, look at the writer's strike last week. Clearly, they won, the studios lost. But it sort of seems like the result is that the studios are going to make less stuff and there's going to be less work for writers.
I don't know if there's ever a winner in a strike.
Fair enough.
And by the way, if there's a winner and a loser, and I look at what's going on in the automobile strike here, and I look at UPS, so the labor can win if you call winning. Someone's got to pay for that. So when everyone in this group goes to send a package next week, it's going to cost them more money. There's no free lunch in this game.
Well, that's my question, which is labor overplaying its hand at exactly, to your point, the moment where stuff is going to get more expensive, companies, eventually that unemployment rate's got to budge, you would think.
I look at it this way. My daughter with her 2 master's degrees sits here and teaches special ed in New York City for less than $60,000 a year. And the guy delivering UPS to my house is earning $170,000 a year. We've got something wrong here in this country. I think the educational system has got to be fixed. So, if there's winners and losers, the losers are all of us because we're not educating our next generation, and a lot of the problems we have are in the educational system. So, I'm all for everyone getting paid, but we've got to understand that there's a transitory mechanism that shareholders expect to get paid, capital expects to get paid, banks expect to get paid back, and at the end of the day, it falls to the bottom. It falls to the consumer to have to make up the difference. So the person who got the writer that got the increase in salary is probably just going to pay more to watch the movie or the script that they produce. Right. So their streaming is going to go up.
Right. President Biden went to a picket line. I don't think anyone was surprised by his politics, but you've advised the president before on economic policy. What would you say?
I would have not advised the president to go to a picket line. I think it creates a bit of a rift. Like I said, it creates a bit of a rift between all of the different areas of concern. We've got an amazing economy in this country, and we shouldn't underestimate it. We are the envy of the world. We've got capital. We have risk-based capital. We have people here that have taken enormous risk in this country and have built extraordinary companies. We look at the companies that we use almost every day in our life. I mean, I'm willing to bet, looking out in that room, that half these people got here in an Uber. I remember that company when it had, 8 employees. And some entrepreneurs took some risk and created that company. I can go through a whole list of companies. We have an enormous ecosystem here in this country that allows people to build companies. As a president of the United States, I think you want to be on the side of growing the economy. I don't think you want to be picking labor versus capital versus quality of life. I think you want to be cheering for all of us.
Do you ever go back into government?
Look, I think the opportunity to serve is an amazing, amazing opportunity. I think everyone in this room should serve the government. It is a unique experience. I have no idea. I was told by a very smart woman one day, never tell people what you will do and never tell people what you won't do.
Would your decision be at all influenced by Donald Trump returning to the White House in 24?
Look, your decision to serve in government is always influenced by the people that you're going to be working with. My decision to work anywhere would be influenced by who I'm working with.
All right. Thank you so much, Gary.
Thank you.
Great to see you.